highest interest rates since 2007, my friends. We're going to find out what it all means for the interest rate market as well as the stock market. Going to dig into so much data here in this segment, but let's start out with contextualizing the recent move in U.S. Treasuries. And right now we're looking at the U.S. 10-year Treasury note price. Now, keep in mind, price and yield move inversely. So the lows in 10-year Treasury notes in terms of price are going to correlate highs in terms of yields. We'll get to the second, but you're seeing Treasuries near decade lows, more than a decade, as it's 2023. And the last time we saw these lows was 2007. You can see there spent a good amount of time around this 10 price in the note in the 2005, 2007 range prior to the financial crisis, which brought rates screaming lower, bond and note prices screaming higher. And we haven't gotten back to those levels since 2007, 2008. Now flip the script a little bit. You can see that 10-year yields are at their highs. 4.25% is the high since 2007. Why are we looking at this 10-year note and the 10-year yield? Well, it is really the benchmark for interest rates. And in a lot of ways, it is the S&P 500 of interest rates, in the same way that you might say, oh, the stock market's down 10% and you're looking at the S&P 500. I'd say, oh, interest rate at their highs since 2007. You're likely to look at the 10-year as it is the true benchmark for, mortgages, car loans, all these different things here. And as you can see, we got up to this 4.25%, the high since 2007. At the later part of 2022, what was happening then? That was the peak in inflation fear. And some of those fears coming up once again, global fear around economic slowdown in China and other places come up again. We just did about how China, maybe some of its U.S. Treasury holdings could be pushing those Treasury prices lower and these interest rates higher. A whole number of things going on here that you can look into. But let's look into this historical price action. It's something that's really interesting to me. This isn't a case of market hits new high and we haven't seen this pretty much ever. Remember, crude oil hit $125 a barrel at the peak of Russia-Ukraine war fear that was affecting commodity markets for a period in, I believe it was the summer of 2020. And we're able to contextualize that with historical crude oil prices the same way that we're doing with yield. When we look back historically, back to the 1980s, crude oil historically had topped out in the low hundreds, 105, 110, 120. I think the highest that it got to historically, looking at crude oil futures since 1990, was just a touch above 140. It's not the same case here with interest rates. Anybody who's since before the financial crisis, the norm then was 4% is the low. And since 2008, 4% has been the high. And really interesting to kind of cut chart into segment, which is to say 1990 till 2007, we're in a range of 4 to 8%, where, like I say, where we are now is kind of the low in that range. And in that period, you had multiple economic downturns that brought interest rates lower, but didn't bring them down to 0% necessarily. Since 2007 to present, 4% has been the high. And when we've seen economic downturns, like, say, the outset of the pandemic in 2020, interest rates didn't go down to 4%. They went down to pretty much a rounding error off of 0%. So this potential new normal was the normal in the 1990s, early aughts, where 4% was essentially the low. And so a really interesting inflection point that we're looking at, whereby the market could have another go at 4% and say, this is the high. We're going to go back to what's been recently normal, around 2%, 3% here. And I'm sure stocks, and we'll get to these correlations in a second, would have a side on that. Now, where it could get potentially hairy for a number of different asset classes is we do jump back in this 4 to 6 or even 8% range we saw in the 90s and 2000s. Now let's look at some pretty direct effects that this could have on our different markets here, and straight away this correlation. And I looked at a number of single stocks, the major indices, a number of commodities as well, and gold was the strongest correlation inversely. Today's a great example, and recent trade has been a great example of when interest rates climbing in recent trade history over several months and years. If interest rates are climbing, most other markets aren't doing too well. You can see the correlations across the board here of major markets that we're looking at in red. And that goes from S&P and even the Dow Jones, although the Dow Jones is pretty close to uncorrelated to interest rates recently. But interest higher in recent trade has led to gold, a non-interest bearing asset, to go lower. That kind of makes sense theoretically. If I'm getting paid a higher interest rate to hold what's called risk-free assets from the U.S. Treasury, then I would demand less of this gold, which theoretically holds value and is risk-free, but doesn't pay me an interest rate, right? And so gold negatively correlate. Amazon and PayPal of stocks, the strongest inverse correlation to interest rates. And right there you see NASDAQ with its more tech lean having a stark negative correlation there, S&P right behind it. But the Dow Jones really was interesting to me, and it makes sense. It's even though it's only 30 stocks, it is kind of more diversified from a sector point than your S&P and NASDAQ, which are, overwhelmingly Apple, Microsoft, Amazon, and a bunch of the big tech stocks. And you pick this PayPal against U.S. risks, and it looks pretty rough. Of course, PayPal has a bunch of its own stuff going on. But keep in mind, why rates have been moving higher over the last couple of years, and why they're toying with these highs is curb inflation. And you might say that, PayPal and Amazon and some of those companies were huge conduits to high inflation. And so in 2020 and 2021, interest rates down to 0%. And you saw some of these tech stocks really bound well off of the pandemic that hit in the early part of 2020. This is kind of I don't want to call it karma, but like flip of that coin, whereby you really profited from low interest rates and lend yourself to inflation. You're feeling the other side of that here, where high interest rates are affecting your growth potential, which stock prices were really screaming higher on in 2020 and 2021. And so, yes, again, PayPal is kind of its own story recently, but you can connect the dots between U.S. rates and PayPal stock price. And all that being said about PayPal, Amazon is there in terms of the strong negative correlation when there isn't necessarily one-off story that's leading Amazon lower as interest rates go higher that would unduly create that correlation. Now, I do want to call out, it's not all bad. One, dollar has been rising amid this U.S. interest rise, and stocks are rallying with rates. I thought really interesting chart here. Some of the stocks that maybe weren't your best performers in 2020 when we had the pandemic fall and the bounce back when interest rates went to zero, obviously texted really well time frame. Caterpillar and Johnson, they're in red and black. One performed decently well during the pandemic in 2021. Now, as the line, U.S. interest rate risen throughout 2022, and now get back to those highs in 2023. These stocks have held on to those gains, and you're seeing Caterpillar look at highs. Johnson & Johnson get close to all-time highs, taking these high interest rates in stride. So not all bad for the stock market, but new highs for interest rates and potentially higher highs since 2007 could have an adverse effect on some of those stocks.